The man who told HMRC he was a citizen of Seychelles spent 3 decades fighting a tax bill and lost. What's today's lesson? You cannot bluff your way out of UK residence, but you can plan around it. We're going to break down split year tax treatment, the rule that can chop your tax year in half, and the real HMRC tribunal cases that show you exactly where the line is. Buckle up. This is the final part of our SRT series. If you've watched parts 1 and 2, congratulations, you know how the 3 tests work and you know the day count grid. Today, we're tackling the planning side, split year treatment, the right cases, the order they're tested in, the temporary non-residence anti-avoidance rule, and the HMRC tribunal cases that have shaped how all of this is actually applied. By the end of this video, you will know more about UK residents than 95% of accountants out there. That's not being cocky. That's how rare cross-border tax expertise actually is. Let's get into it. Default position. Residence is an all or nothing status for the whole tax year. You're either a UK resident from 6th of April to 5th of April, or you're not, which is brutal if you leave on 1st of May or arrive on 1st of February. Your overseas income for the rest of the year shouldn't be UK taxable, but the default rule says it is. So Parliament saw the problem. Schedule 45 Part 3 of the Finance Act 2013 introduced 8 cases where the year is split into a UK part and an overseas part, which is referred to as the split year treatment. During the overseas part, you're generally taxed as a non-resident, meaning foreign income, foreign gains, and overseas employment income aren't in the UK net. 3 rules to drum into your head before we go further. Rule number 1, you must be UK resident for the whole tax year for split year to be available. If you're fully non-resident, no split year is needed. Rule 2, split year is automatic. You can't pick which cases you'd prefer. You must apply HMRC's ordering rules and use the first case that fits. Rule 3, split year only applies to certain types of income and gains. Some sources like UK rental income are taxable in the UK regardless. So here are the 8 cases. 3 of them are leaving cases, cases 1, 2 and 3. 5 are arriving cases, cases 4 to 8. So case 1, leaving and starting full-time work overseas. Case 2, partner of someone who started full-time work overseas. Case 3, ceasing to have a UK home. Arriving, starting to have a UK home only and no overseas home. Case 5, starting full-time work in the UK. Case 6, ceasing full-time work overseas as a returning expat. Case 7, partner of someone in case 6. Case 8, starting to have a UK home where there was none before. So case 1 covers people leaving to start full-time work overseas. You need to start working full-time abroad, satisfy the overseas work conditions for the rest of the tax year, and be non-UK resident in the tax year. The split happens on the day you start the overseas job. Case 2 covers your partner. If your spouse, civil partner, cohabitee qualified into case 1 and you accompany them, you can also split the year, provided you don't breach the day count cap and you're non-resident next tax year. The split date is the later of when your partner started their overseas job or when you actually went out to live with them. Case 3 catches everyone else who simply leaves. The trigger is ceasing to have a UK home. You must have no UK home for the rest of the tax year, spend fewer than 16 days in the UK after you leave, and within 6 months of leaving you must establish enough overseas connection. Broadly, become tax resident or have your only home in another country. Case 4, starting to have a UK home only. The day you start to have a UK home and no overseas home, and you have it for the rest of the year, the split happens. Watch the only sell the Dubai flat, then buy in London. Case 4 in play. Case 5, starting full-time work in the UK. Mirrors case 1. The day you start the UK role is your split day, provided you stay in full-time UK work and meet the conditions for 365 days. Case 6, ceasing full-time work overseas. The classic returning expat case. Your split day is the day you finished overseas work, provided you were non-resident in the previous tax year because of overseas work, and you're UK resident in the year of return and the year after. Case 7, your partner of someone in case 6. Similar logic to case 2. And case 8, starting to have a UK home where there wasn't one before. Slightly different from case 4 because you can have an overseas home as well. Useful for people setting up a UK base whilst also keeping a foreign one. The order of test. Critical. The cases are not interchangeable. HMRC's rule is for leavers. You test case 1, then 2, then 3 in that order. Use the first case that fits. Even if Case 3 would give you an earlier split day. For arrivals, the order is 4, 5, 6, 7, 8. There are tiebreaker rules where multiple cases apply, generally giving you the earliest possible UK part. Get this order wrong and HMRC will simply redo the analysis check properly. If they will not let you cherry pick. Now we're going to talk about the trap that catches so many founders, fund managers and equity rich employees that I've genuinely lost count. The temporary non-residence rule, built into Schedule 45 Part 4. The idea: if you leave the UK, realize a big lump of income or gain whilst you're overseas, and come back within 5 years, certain types of income and gains get pulled back into the UK in your next tax return. Specifically, your temporary non-resident, if you're a UK resident in at least 4 out of the 7 tax years before your year of departure, and your period of non-residence is 5 years or less. If both conditions are met, the following items realized during your non-resident tax period are taxed in the year of your return: distributions from closed company including dividends, pension lump sums, certain employment-related securities, capital gains on assets you held when you left, and a few more. So the dream of leaving the UK paying yourself a 5 million dividend out of your trading company tax-free and coming back, smashed. The dividend gets dragged back into your UK tax year, the year you return. The escape hatch: stay non-resident for at least 5 complete tax years and a fraction. That's the magic period. If you can clean break, structure your overseas residence properly and stay outside the rule, the trap doesn't spring. What are the HMRC tribunal cases that shaped the SRT? Gaines Cooper, 2011, UKSC 47. Pre-SRT, but the case that built the SRT. Robert Gaines Cooper claimed Seychelles residence from 1970 onwards. He limited his UK days, built a life of sorts in the islands, and pointed that HMRC's old IR20 booklet as a contract. But the Supreme Court disagreed. IR20 wasn't a binding statement. His life was still UK, and a distant break from UK life is more than a day count. So what's the lesson today? The SRT is mechanical, but the courts still look at hard facts. If your evidence looks like Gaines Cooper, UK family, UK schools, UK collections, UK clubs, expect a fight. Davies and James versus HMRC, 2011, UKSC 47. Heard alongside Gaines Cooper, 2 Welsh accountants tried to argue residents in Belgium with similar profiles. They lost too. The combined judgment is the high watermark for the principle that residence requires real change in life pattern, not just paperwork. Read it once and you'll never rely solely on having the right number of days. Hankinson versus HMRC in 2011, UK UT 421. Pre-SRT but instructive. Mr. Hankinson sold £1.55 million worth of shares while claiming non-residence. The upper tribunal looked at family ties, accommodation and his centre of vital interest, found him resident and the gain was taxed. Modern relevance is that the sufficient ties test now mechanizes what Hankinson had to argue from first principles. Family and accommodation plus UK gravitational pull equal resident. Same principle codified. Glynn versus HMRC in 2013. This one swung the other way. The taxpayer won. The Glynn family decamped to Monaco. The first tier tribunal accepted that despite frequent visits and the UK property, he had genuinely shifted the centre of his life. Important quote: a settled and chosen way of life in the new country. If you're leaving the UK, your evidence pack should look like Glynn's: Monaco lease, Monaco social club, memberships, Monaco doctor, Monaco everything. That brings us on to Daniel versus HMRC in 2014, UK FTT 173, a Saudi-based Brit, pre-SRT. The tribunal had to assess where he was ordinarily resident given working patterns and family. Useful for the SRT era because of how it treated the day count, how the settled purpose in another country. Set against the new statutory framework, Daniel reminds us that even objective tests like the SRT carry a layer of evidential burden. You still have to prove your hours, your home, your purpose. Embrichios versus HMRC, a modern one. The Court of Appeal grappled with HMRC's information powers and the residence inquiry process. It's about partial closure notices, but the underlying inquiry was about whether the taxpayer had become non-UK resident. The case stands as a warning. HMRC can run extended inquiries on residence questions and demand significant disclosure before closing. If you're claiming non-resident, your filing position must be tight, supported, and consistent year on year. The first tier tribunal has been decisively literal on the SRT. In recent decisions on accommodation ties, home status and UK working days, judges have stuck firmly to the wording in Schedule 45, ignoring the narrative arguments unless the statute itself opens the door. The takeaway: if the statute says 91 days, plan to 90 with margin. If it says 35 hours, keep timesheets that show 36. Map the timeline. Build a calendar that runs from the start of the year before you move to the end of the year after. Plot every flight, every move, every contract date. Pre-departure. Agree the case, likely 1, 2 or 3. Lock in a clean break, change schools, end leases, register with overseas tax authorities, transfer GP, cancel UK gym memberships, the works. During non-resident, mind the ties. Do not casually rack up UK working days. Track every visit. Use the deeming rule as a fence, not a finish line. Watch the 5-year clock for temporary non-residents. Big gains and dividends should be planned around the safe harbour, not the trap. Returning to the UK. Choose between case 4, 5, 6 or 8 by structuring the trigger event deliberately. The day you sign the UK lease can shift hundreds of thousands of tax. Document everything: boarding passes, payslips, calendars, signed contract, utility bill. HMRC's inquiries on residents often runs 3 to 5 years after the year in question. If any of this is on your horizon, leaving for an overseas role, returning to the UK, planning a big liquidity event abroad, or you're honestly not sure where you stand for last year, book a residency review with Evolve Tax. We don't give 30-page memos that will confuse you more. We give you a conclusion, a day count map, and a defensive evidence pack you can actually use. If this series helped you, the best thing you can do is share it with one person who needs it. Tax is the most expensive subject most people never study. Let's fix that. Thanks for watching the whole way through. I'll see you in the next series where we're tackling non-dom reform, the new 4-year FIG regime, and the post-2025 landscape that everybody is getting wrong. Until then, take care.